90% of traders lose on the 1-minute time frame, but if you know this strategy, you'll be among the 10% of winners. For a scalper, speed is everything. On the 1-minute time frame, if the indicator is slow, you'll practically miss the opportunity to enter or exit. That's why EMA is the best option. Now, why do we choose two EMAs? EMA 10 acts like a fast radar. It shows the first small changes in price direction. EMA 30 acts like a powerful filter. It tells you whether the main trend is still bullish or bearish. When you put these two together, you essentially create a filter plus signal system. For example, suppose EMA 10 comes and crosses EMA 30 upwards. This signals the start of an uptrend. But if this cross is against the main trend, you will understand that the signal is weak and the probability of it being fake is high. The first step is to choose the right time frame. We are working with a 1-minute time frame here. Why 1 minute? Because scalping means catching small market movements in the shortest possible time. After opening the chart, you need to add the EMA indicators to your chart. The first EMA is set to 10. The second EMA is set to 30. Set each one to a different color. For example, EMA 10 is red and EMA 30 is blue. This way you can easily tell which one is faster. The most important thing is that EMA 10 reacts very quickly to changes due to its short period. So whenever the direction of EMA 10 changes, it means that the market is changing. But you should not rush into a trade until this change is in line with EMA 30. SMC is actually the view of financial institutions and large banks towards the market. They are the ones who control the main flow of liquidity. Liquidity. The market is always looking for liquidity. For example, when all traders place their stop losses behind a ceiling or floor, the banks know that liquidity is concentrated there. Order blocks. These are areas where institutions have placed their large orders. When the price returns to these areas, the likelihood of a strong reaction is very high. Break of structure, BOS. This is where the market structure breaks and the trend changes. These breaks usually occur with the influx of large amounts of money. Now imagine the combination of EMA and SMC. Suppose the EMA 10 crosses the EMA 30 upwards. This in itself is considered a buy signal. But is that enough? No. Now you need to see if this cross happened near an important order block or not. If yes, this means that the probability of the move continuing is much higher. Similarly, if the cross occurs where there is high liquidity or a market structure is broken, that signal is much more valid than usual. Thank you for liking the video. Let's go to the most important strategy from which you can learn a lot. When we think about scalping strategy, it all comes down to when to enter a trade and when to exit. Even the best indicators and the strongest analysis are useless without clear rules. So let's take a detailed and step-by-step look at the entry and exit rules of this EMA plus SMC strategy. 1. Entry rule. To enter, we have two main conditions. EMA cross. When the EMA 10 crosses the EMA 30, it is the first signal to enter a trade. If the cross is upwards, we have a buy signal. If it is downwards, we have a sell signal. SMC confirmation. This cross should be close to an order block or liquidity area. If this condition is not met, the probability of the trade being fake is very high. That is, we first get the EMA signal, then by looking at the market structure and liquidity, we make sure that big money is behind this move. 2. Exit rule. This is where most beginners make a mistake. Many either exit too early and lose the main profit, or exit so late that the trade reverses and they lose. For a safe exit, you can set your target at the previous liquidity level or the next order block. A simpler way is to exit the trade whenever the price returns to EMA 10. This way, you won't be surprised by the opposite direction. Third stop loss rule. No trade is reliable without a stop loss. In this strategy, the best place for a stop loss is behind the last order block or behind a strong support/resistance level. This way, if the market moves against your expectations, your losses will be limited. 4. Trade management. Remember that everything happens quickly on the 1-minute time frame. So before entering, you need to know exactly where your target is, where the stop is, and what volume you are entering the trade. Many people know the best strategies, but because they don't control their risk, they end up losing their accounts. 1. Risk percentage per trade. The golden rule is that you shouldn't risk more than 1 to 2% of your total capital on each trade. That means if your account is $1,000, you shouldn't risk more than $10 to $20 on a trade. This will ensure that even if you lose several trades in a row, you still have enough capital to continue. 2. Risk to reward ratio, RRR. One of the biggest mistakes traders make is taking big risks for small profits. Your reward to loss ratio should always be at least 1 to 2. That means if you risk $10 on a trade, your target should be at least $20 in profit. That way, even with a 40% win rate, you can still make a profit overall. 4. Psychological management. Risk management is not limited to numbers. Your mind must also be managed. When you get stopped out, you shouldn't rush into the next trade to cover your losses. What is called a revenge trader. This is the most dangerous trap for traders. First, EMAs help us to identify short-term and medium-term trends in the shortest possible time. EMA 10 acts like a fast radar, and EMA 30 acts like a strong filter. Together, these two allow you to notice changes very quickly, but at the same time, not to get caught up in fake signals. Second, we brought SMC into the game, something that most novice traders do not pay attention to. Here you learned that EMA crossings alone are not enough. You need to see if this crossing occurred near an order block or liquidity level. This look will allow you to distinguish between a real market movement and a simple trap. Third, we reviewed the entry and exit rules step by step. You learned when to enter a trade, how to set a target, and where to place a stop loss. These rules are like the main pillars of a building. Without them, the entire strategy collapses. Fourth, we emphasized risk management. Because without capital control, even the best strategies will end up losing. How to determine the risk percentage, how to maintain a risk-reward ratio, and how to avoid revenge trades are all principles that a professional trader must follow. Finally, what makes this strategy powerful is the combination of simplicity and depth. That is, we use both a simple tool like the EMA and deeper market concepts like smart money. This combination allows both beginners to use it and professional traders to look at it as a powerful filter. Thank you for watching the video so far. I hope you can make the most of it. Watch the video related to the strategy.